Hi all. In today's discussion, we're going to see about final accounts for not-for-profit organizations. In the previous class, we just saw final accounts of sole proprietorship. Here, we need to prepare a trading account, penal account, and a balance sheet for final accounts. And with respect to manufacturing entities, there is another additional account which is known as manufacturing account. Okay, these are the four accounts which we created. But in a similar way here, final accounts for not-for-profit organizations, also we need to prepare the balance sheet. But the other accounts are a little different. We'll just look into that in detail. Okay. So before looking into that, we just understand the term what is not-for-profit organization, basically called known as NPO. Okay. Introduction. So generally, this NPO, no, which means not for profit. So here the main motive of these not for profit organization is to not make profits. Main intention for this NPO entities is to provide service to the public. Okay, and these will include hospitals, education institution, cooperative society, clubs, etc. All of these things will come under NPO. Okay, and it means these institutions are established with the objective of providing services. The objective is to mainly provide services and not with the object of profit making. Profit making is not the motive. Okay, and when coming to the final accounts, what are the accounts we need to prepare? That is nothing but receipts and payments account, income and expenditure account, and balance sheet. So what is the receipts and payment account? Receipts and payment account is nothing but similar to the cash account. Cash account to be prepared. Okay. Here the cash account is prepared based on cash basis, not on accrual basis. Okay, whatever receipts and payments, whatever receipts and the payments are recorded. Okay, similar like the cash account. Then coming to income and expenditure account. Income and expenditure account is nothing but a P&L account. It's nothing but a which is similar to the P&L account. This account need to be moved. Then coming to the balance sheet. Balance sheet here the term uses statement of affairs. Okay, balance sheet or statement. We prepare the balance sheet. So all these need to prepare in order to finalize the non-profit organization books. Okay, coming to the next slide. Here we will look into the types of income. What are the types of income that might come in the NTU? First thing here, credit to the income and expenditure account, which means it is an income, which is an income to the income and expenditure account. Income to the income and expenditure account. That is nothing but donations will be the income, membership fees, subscriptions. See, for example, here, say for example, we have a sports club. Okay, sports club. Sports club will be getting some donations. Sports club, hospital, or education institution, whatever it might be. Okay, example will take in sports club. So here, some people might donate to the sports club. So whatever the donation is being received, no, that will be the major income of this NPM. Okay, so donation will be one of the income. Then next coming to membership and subscription. Membership fees as in, say, for the club will have membership fees. Okay. Membership fees might be a lifetime membership also, or a yearly subscription also. Yearly membership fees, that is which is known as subscription charges. Okay, that also might be the thing. Okay, if it is a lifetime membership fees, then the accounting treatment is different. It won't come in the income and expenditure. On the whole amount won't come in the income and expenditure. Only that relating to that part of the year, it will come. That part of the accounting period will come to the income and expenditure account. Otherwise, subscriptions anyway taken in the income and expenditure account. So it is basically a P&L. Okay. Then coming to next item, amount received for specific special activity, charity show collections. If any special activity which is being done, okay, and that time whatever the collections is being done, that will be considered as an income. Then coming to entrance fees. In sports, if any matches, the sports club is organized any match, no, if for the entrance for admission, if they're charging in ticket fees. Okay. If it is small, which needs to be taken in the P&L account, that is income and expenditure. If the amount is big, the same to be taken in the balance sheet. Okay. So these are the incomes, most likely income which you might see in the NT. Then coming to the balance sheet items, liability side, which is non-recurring. These are recurring items and these are non-recurring items. So what are the items here? Donation received for capital expenditure, for the specific capital expenditure, say for example, building. Okay, donation is received for the specifically for the building or to purchase of any plant and machinery or for any specific activity. So that that will be coming in the balance sheet. Then donation is received for specific purpose. Any other specific purpose also to be taken in the balance sheet. Then comes to we have legacy, life membership fees, endowment fees, and entrance fees. Entrance fee we discussed. If it is small amount, take it in P&L account, income and expenditure account. If it is a big amount, then that to be taken in the balance sheet. Okay. Then coming to legacy, life membership fees. Life membership fee also we discussed here. Then coming to legacy and endowment fees. Okay. We look into this what is it in detail in the next slide. Treatment of special items in NPO. Treatment of special items in NPO. Special items as in here, really the donation is the main income which the NPO will be receiving. Okay, this is donation is nothing but the income purpose. If it's receiving any for any specific purpose, then that to be taken to the capital fund. Otherwise, it will be reflecting the income and expenditure account. Okay. Sure. Special purpose donation. If at all, if the donation is special purpose, if the donation has been received to meet some capital expenditure, like I mentioned, if any for any building, purchase of land and machinery, then purchase of books or equipments or building, all that will be shown on the liability side of the balance sheet. It will be shown on the liability side of the balance sheet as a capital fund. Capital fund, or this if any specific fund, then you can show the name specific fund account. Okay. Then if the whatever expenditure which has been incurred, whatever expenditure is being incurred, for example, say this is the building fund, okay, building fund, whatever expenditure is being incurred. So whenever the expenditure is being incurred, actually whatever the expense is incurred, it won't come in the income and expenditure. That will be debited from this fund account. Say for example, this fund account has a balance of 10 lakh. You have paid for the initial for the building, initial bricks, cement, whatever the charges you have paid, that whatever you pay to the contractor, that will be minus. Say, for example, 2 lakhs, right? The fund account balance will be 8 lakhs. So we'll be reducing from the funds, whatever expenses which is being incurred. Okay. If donation is received to meet some one-time revenue expenditure, such expenses have not been incurred during the current financial year. Such also will also be shown on the liability side. Okay. But in case expenses have been incurred, any deficit or surplus is shown on the income and expenditure account. Okay. Done. General donation. General donation will be taken in income and expenditure. Okay. Done. Then coming to legacy. Legacy as in, say, for example, if there's any deceased person and uh, his will says that all the property should go to the NPO. Okay. So whenever this is done, when any property or amount is received under the will, when you receive any property under the will of a deceased person, it is treated as a capital receipt. Okay, because we will be receiving the property, so will be treated as a capital receipt shown in the liability side of the balance sheet. Usually taken to the capital fund. Okay. Then coming to entrance or admission fees. So this already we discussed. If the small amount, take it in income and expenditure account. If it is a big amount, take it to the balance sheet. Okay. And if the question is silent, then take it as a capital receipt and add to the funds and add to the capital fund. Say even in the question is silent and the amount is very small, then you have to put the additional note in the answer, saying that since the amount is small, you take considering it in the income and expenditure account. Okay. Then coming to life membership fees. Coming to life membership fees here, when you receive a life membership fees, okay, this is for there won't be any yearly charge, monthly or yearly renewals won't be there. It's a one-time fee which is being collected for the whole life. Okay. So what happens here? Whenever the life membership fees is a very lump sum amount, say for example, when 20 lakhs is being collected, okay, when 20 lakhs is collected. So a part of the amount will be whenever we collect this life membership fees, this will be taken in the balance sheet itself. This will be taken in the balance sheet itself. But every year on year, a minimum amount, not a minimum amount, a certain amount will be charged to the income and expenditure account. Will be charged for income and expenditure account. If fund time subscription is received from a member for his whole life, such the subscription cannot be treated as an income for 1 year. This item can be treated in the following manner. There are two methods. The total amount received during the year may be credited to the life membership fees account. Okay, this will be shown on the balance sheet, liability side. Okay, first take it to the balance sheet. Then from there you can transfer. In case of death of the member, the subscription will be transferred to the accumulated fund. This will come to this later. Second method is out of the total of the life membership fees received, an amount equal to normal annual subscription. An amount equal to normal annual subscription will be transferred to the credit of the income and expenditure account, which I discussed. So part of the amount will be transferred here or to the income and expenditure account. Okay. And the balance, whatever the balance is there, will be shown under the liability side of the balance sheet until it's been exhausted. So these two methods can be followed. One is either you can show it as a life membership fee account in the balance sheet without transferring it to P&L. One is you can transfer a minimum, a certain amount year on year to the P&L account, treating it as an income. In absence of any information, life membership fees is to be added to the capital account. So if the question is silent again, just take it to the capital fund account. Okay, and no need to transfer it to the income and expense account. Directly take it to the capital fund account because it's a life membership fees. It's a lump sum amount. Then coming to special funds. If you're receiving any special funds, sometimes special funds are created. You'll have to create. We'll just go quickly. Sometimes special funds are created to meet some recurring expenses such as sports fund, prize fund, etc. Okay, there's a certain fund which is being created. For example, in the sports club, no, sports club, in order to for the distribution of prizes, they have to created a prize fund account. Prize fund account. They have to created prize fund account. So any amount received for such purpose, any amount received for such purpose is credited to the relevant fund account. If you have a specific fund account, any amount related to such fund will be credited to the such fund account only. And any expenses which has been incurred will be debited from such fund. Will be debited from such fund. Okay. And here what happens is whenever specific funds are maintained, that balance, whatever the fund balance, no, will be there in the balance sheet. Okay. But that will be idle funds. Okay. The same funds can be invested elsewhere also. So when you're investing that those funds and whatever the income is received from those funds, any income which is being received from those funds, that will be again credited to the specific fund account only. Okay. So if the amount here, if the amount of funds has been invested in some securities, income earned on such securities is also credited to the fund account. Okay. Done. If donor instead of paying cash has given some securities or instead of giving cash directly to any fund account, instead of giving that, he is giving some asset, some other readily saleable asset. The value of such asset will be credited to the specific fund account, and similarly, the asset value also will be shown in the balance sheet on the asset side. Okay. The amount of fund corresponding investment will be appearing in the liability side and asset side of the balance sheet respectively. Okay. Done. Then there's something called as endowment fund. Endowment fund, as in here, the asset will be there. Okay. Any income which is being generated from that asset, okay, only that amount to be utilized. The asset cannot be utilized. Only if it is a donation received, only income from such donation to be used for specific purposes. In such case, income related to the specific fund account should be added to these funds on the liability side, and all related expenses should be deducted from such fund. Okay. Only income from that particular asset to be used for the specific fund account. Okay. Income and expense, if it's income credited, if it's expense anything, debited from such fund account. Grants. Grants, as in this will be received from the government, usually for the relief of the public or for the service of the public. The government sometimes will give some grants, okay, for the betterment of the public. So that whatever the fund is received, no, it is a financial fund received from some public funds as local body or government body, unless it is received from some specific purpose. If it is received for specific purpose, treat it as a specific fund only. If not, you can treat it as a revenue receipt. Okay. These are the special items and the treatment ought to be done. Then coming to the difference between receipts and payment and income and expenditure account. We already discussed receipts and payment is nothing but similar to cash account. Income and expenditure account is nothing but similar to P&L account. Okay. So keeping this in mind, we look into into this in detail. Receipts and payment account. Receipts and payment account is a real account. The cash account is a real account. Income and expenditure, all expenses and income and so it is a nominal. Okay. This shows cash balances. This shows cash or bank balances. This shows the profit and loss. That is nothing but surplus or deficit. Here we don't use the word profit or loss because it's not meant for profit. We just use the word surplus. The excess money we have, instead of the word profit, we use the word surplus. If we don't have excess money, then we use the word deficit. Okay. Here in receipts and payment account, both capital and revenue items are taken. Because cash account, right? Whatever amount we receive, capital or revenue, doesn't matter. So all capital and revenue items are taken. Okay. It starts with opening balances. The format of the receipts and payment receipts and payment account will be opening balance, opening balance, that is nothing but cash balance, and closing balance also given. Closing cash balance also given. And all the receipts, all the increase will be recorded here, all the decrease will be recorded. Similar like the cash account. Debit side is receipts, credit side is payment. Okay. Coming to income and expense account, only revenue items of collected are taken. So only revenue items are taken here. Similar to the penal income, similar to penal income and expense account. Okay. Income and expense account. So all the incomes will be recorded, all the expenses will be recorded. Debit is debit side, credit side. Debit side is nothing but expense we have. Here we have the income. Okay. It does not have opening balance and difference between debit and credit side shows surplus. So whatever difference is that is being termed as a surplus. And debit side is expenses, this side is expenses, and credit side is the income. Okay. Clear. Then we also have accounting for education institution. Okay. Education institution also comes under not-for-profit organization. Okay. So here the main income for education institution is either donations from the public or fees from the students. The education institution will be collecting a certain fees from each of the students. Okay. That fees they'll be utilizing it for making the payments to teachers or any other payments which is there. Okay. Then there'll be grants from the government. Government will be giving specific grants to these education institutions. Okay. Then coming to the meaning of the fund. Here, fund, uh, here, if you have to use the word fund, no, then uh, in just look into this. The term fund is strictly applicable to the amount collected for specific purpose. If at all if it's collected for a specific purpose and it is being invested, if it's collected for a specific purpose and invested, then you can use the word fund. That is another word prize fund, building fund, etc. If it's collected and if it's not invested, if it is not invested, then you can use the word account. Okay. Like for example, building collection account, fees collection account, anything account you can use them. Okay. Then coming to fund-based accounting. It involves preparation of financial statements on fund-wise base. That is, separate ledgers are maintained for each fund. Whenever you have a separate fund, separate ledger to be opened, and whatever the income and expense of relating to that particular fund should be debited or credited to that particular fund only. Okay. Then coming to for asset creation, so purchase of construction of any assets like building for specific activities, knowledge dispersed, distribution of prices. Only might be anything. Okay. For any cultural events or distribution of prices, anything specific fund might be created. Now we look into the journal entries leading to the fund. Whenever you're receiving, okay, whenever you're receiving the fund, receipt or investment entry, same for all funds, whether fund related to capital expenditure like lending or other funds like price fund. Any fund it might be, whenever you're receiving, that is nothing but debit, cash and bank account debit to respective fund account. Whatever fund you're being receiving, that fund account has to be credited. So when the money will be whenever you receive the money, that fund also to be invested somewhere. When you're investing the money, respective fund investment account debit to cash or bank account. Okay. Then when the interest is being accrued, whenever you're getting the interest on that particular fund, no, you'll be receiving that cash in bank account debit, accrued interest account debit to respective fund account. That fund account will be credited. That fund account will be credited. That will be added to the fund itself. Whatever the income which we are receiving, then that amount will be added to the fund itself. Okay. Done. Then we saw the income. Now we'll see the expenditure. How do we record the expenditure? Okay. Whenever the capital expenditure is being made, then you can use the word asset, whichever particular asset. If the asset is in progress, if it's towards construction like building, then whatever expense you're making, it won't be one-time expenditure, right? On a regular basis, you're making expenditure. That time you can use the word capital work in progress. If it is a one-time, if you're purchasing any building, then you can use the word building. If you're already constructing it, then you can use the word capital work in progress to contractor. Contractor is nothing but a vendor to whom you're buying items, bricks, cement, other things, which is required for the construction progress, steel, okay, all of those things which is required. So capital work in progress account debit to contractor's account. When you're making payment to contractors, in similar way, cash will be credited, contractor's account will be debited. Okay. On assets being ready or completed. When the asset is ready or completed. Okay. When it is ready, what will happen? The capital working to the account was debited initially. Now we'll have to credit that. Now we'll have to credit that and debit the asset account. Debit the asset account. Whatever the asset account, plant and machinery or building, debit the respective asset account at the value. Okay. Then after all of this, now there will be some balance in the fund. The total fund you would have received, say 10 lakhs. Okay. In that 8 lakh you have spent, 8 lakh you have spent. So balance you have 2 lakh. So that 2 lakh, initially would have credited it to the respective fund account. Like in the previous example, it has been initially when you receive, it will be credited to the respective fund account. So this respective fund is that whatever the balance is there will be transferred to general fund or capital fund account. Okay, that balance will be transferred to general fund or capital fund account. Okay. One. Then expenditure or spending out of the fund for funds other than capital expenditure. This is being looked to the items of capital expenditure. This is other than capital expenditure. When you're incurring any expenditure other than capital expenditure, that is respective fund, whatever the prize fund or the sports fund, whatever is it, respective fund account to bank account. Okay. So I hope the theory part is clear. If you if you're solving more and more questions, then we'll be more clear on this. Okay, done. Thank you. Hi all. Today's discussion is going to be about incomplete records or single entry system. Here, as the name really suggests, the incomplete records means the books are not completed. Okay, this is just an extension of sole proprietorship. Okay, and single entry system means wherein only one part of the entry has been booked, other part is not booked. Basically, cash entry is booked, the corresponding entry is not. Okay, we'll get into detail introduction. So here, how do we ascertain profit? When the books are incomplete, how do we ascertain profit? So method of ascertaining profit or loss under single entry system. There are two methods. One is the statement of affairs method. We prepare opening balance sheet, and closing balance sheet. And whatever the difference is that it will be the profit. That is one method, statement of affairs method. Okay. Second is conversion method. In conversion method, we complete the accounts. Okay. So all the data, we prepare all the incomplete records. That is data's account, creator's account, cash account, all the accounts which are incomplete, we complete it. And from those balances, we'll try to find the profit. We're transferring those balances to P&L and balance sheet. Okay. So the first method, that is statement of affairs method. Here, total capital at the end of the year is compared with total capital at the beginning, and the profit is calculated as under. That is total capital at the end minus total opening total capital at the beginning, add drawings less capital. This is nothing but opening capital plus additional capital minus drawings and add any profit. Will give you closing capital. Okay, you just rearrange this and we'll be getting the profit. Start from the closing capital. So closing capital minus opening capital, what is plus will become minus, minus will become plus. Okay. The balance sheet will be profit. This is one of them. So basically in this method, you prepare the opening balance sheet and the closing balance sheet, and then with this we'll be finding the profit. Then coming to conversion method. In the conversion method, here all the incomplete records are there, no? All the scattered information. Here all scattered incomplete records is converted into double entry system. In addition to the trading account, profit and loss account, we also open these many accounts, ledger accounts inverted. So whatever the balance from these accounts is transferred to the profit and loss account and the balance sheet, and we try to complete the books of accounts. And those balance figure will give us the profits. Okay. We look into the accounts one by one in detail. That is, first is preparation of various accounts. First is debtors account. In debtors account, we'll have debtors in asset account, right? Debtors is an asset account. So all opening balance will be on the debit side The closing balance will be on the credit side. Okay, similarly, the opening balance is on the debit side, closing balance is on the credit side. And we have credit sales, we have on the debit side, bills discounted, expenses charged, cash received, bad debts discount allowed, bills receivable, sales debit. So usually the credit sales will be the balance agreement in this account. Generally, the credit sales will be the balance agreement. So this balance agreement will be taking it to the P&L account and then completing the P&L account there. Okay. So these are the items here, all the list of all the items have been summarized. So these are the items which might come in the debtors account. Okay. Cash received, bills of bad debts, discount allowed, bills receivable, sales and closing balance. Done. Then coming to, and sometimes if the opening or closing balance is given, that also might be the balance sheet figure. Okay, but generally the credit sales will be the balance sheet figure. Then coming to the creditors account. In creditors account, similarly, if this is an asset, it's a liability, creditors account. So opening balance and closing balance will be there. Apart from that, we'll also have credit purchase, bills payable dishonored, endorsed bill dishonored. Then coming to cash paid, discount received, bills payable, bills receivable dishonored. Again, here the balance figure will be usually the credit purchases. Credit purchase will be the balance agreement. Okay. And also sometimes the balance agreement can be the opening balance or closing balance of creditors. Done. We'll move on to the next account. That is bills receivable account. Okay. Bills receivable again an asset. Opening balance is given, closing balance is there. In bills receivable, whatever the debtors will be as well. So debtors will be taken to the debit side, which is drawn during the year. Additions basically. And then cash received, bank, discount, total debtors which has been dishonored, total creditors which has been endorsed. Okay, all that will be coming in this bills receivable account. Then coming to the next account, that is bills payable account. In bills payable account, again we'll have opening balance, closing balance. Apart from that, we'll also have the total creditors, bills accepted for the bills accepted during the year. Then if anything is dishonored, that also will be coming in this account on the debit side, and we'll have having a close balance, closing balances. Okay. Then coming to cash book. Cash book is very important in the income accounts. Cash book is very important. Okay. So here, if there are bank transactions, cash book should be prepared having two separate columns. See, either you can prepare a two column cash book, okay, or you can prepare a cash book and a cash account and a bank account separately. You can prepare cash account and bank account separately if both the balances are given. Okay. If not, together you can just prepare a one account. Okay. Or else also you can prepare a columnar cash account. Okay. If there are bank transactions, cash book should be prepared having two separate columns, one for cash transactions and other for bank transactions. Sometimes detail of bank transactions are not available. In such case, single column cash book should be prepared containing cash as well as bank. Containing cash as well as bank for both single account is prepared. Okay. So a list of items have been given which might appear in the cash book. So we'll discuss that one by one. And opening cash balance will be there and closing cash balance will be there. Apart from that, we'll also have any cash sales, collection from debtors, collection from bills receivable, additional capital introduced, other receipts, other income, any other income it might be. Even the balance owed of balance of reserve will be shown on the credit side. Bank owed of balance of reserve. Then cash purchases, uh, paid to creditors, paid for the bills payable, all the expenses. The balance will be increasing and the balance will be decreasing. And the drawings, then the closing balance. So these are the items which might come in the cash flow. But here the main balance figure which might come into question is that with respect to the cash sales. Okay. This will be the balance figure. So this may not be on all the time, this may not be the same thing. But you generally in the question, this cash sales, what is it? No. This will be the balance figure. So this will be taking into the P&L account. From there, you'll be finding the profit and loss and you'll be having the balance sheet. Okay. So there are some other important points. So to find the profit, there is nothing but closing capital minus opening capital. We already discussed this. Then opening capital is equal to closing capital. Opening capital is equal to closing capital plus drawings minus additional capital. Okay. Closing capital is nothing but opening capital plus additional capital minus drawings. Just it's been rearranged. But you can just remember this. Closing capital is equal to opening capital plus additional capital minus drawings will be giving you the closing capital. You can also add the profit plus profit. Net profit. Okay, and we'll give you the closing capital balances. Now, with this, we are done with the chapter income accounts. Okay, you can solve more questions for better understanding. Thank you. Hello, today's discussion is going to be about partnership and LLP accounts. In partners, from exam point of view, this partnership and LLP accounts has a weightage of 15 to 20 marks. Okay, and the next chapter, which we're going to company accounts, also has a weightage of 15 to 20 marks. So, from exam point of view, this partnership and company accounts is very, very important. Yeah, these two chapters are very important. This partnership in LLP accounts has six divisions basically. That is introduction, goodwill, admission, death, admission, retirement, death, disclosure. Okay. So we'll be discussing one by one in detail. Okay. So today's discussion will be about introduction and goodwill. We'll cover all the theory what is there in introduction and goodwill. Okay. Done. So here, in partnership accounts, so we'll have to be preparing trading and profit and loss account as usual, and balance sheet will be preparing like another sole proprietorship and income records, which we saw. In addition to that, we also need to prepare the profit and loss appropriation account. So what is this profit and loss appropriation account? There's an additional account which is prepared after the P&L is prepared. Okay. Once you prepare the P&L account, whatever the net profit balance you get, right? That balance will be transferred to the P&L appropriation account. Okay. From that balance, if any interest on capital to be paid, or if partners remuneration to be paid, okay, partners remuneration and the share of profit, all that will be captured in this account. All that those entries will be captured in this account. Okay. And also apart from that, we also need to prepare capital accounts of partners. Under capital account of partners, we have two methods: fixed capital and fluctuating capital. Okay. In the coming slides, we'll look into that in detail. Okay. So first, we'll understand the term partnership accounts. An individual that is a sole proprietorship may not be in a position to cope up with the financials and the management demands of the present day business world. As a result, two or more individuals may decide to pool their financial and non-financial resources to carry on a business. So partnership can have two or more people, two or more. Sole proprietorship is just one. This is two or more. Partnership definition is that partnership is the relation between persons who have agreed to share the profit of a business carried on by all or any of them acting for all. Okay, done. Then coming to LLP accounts. LLP is also similar to partnership. The only difference, major difference is that here the liabilities are limited. In partnership, liabilities are unlimited. Okay. The limited liability partnership is viewed as an alternative corporate business proposal that provides the benefits of limited liability, but allows its members the flexibility of organizing their internal structure as a partnership, which is based on a mutual arrived agreement. LLP will be a separate legal entity, similar like a company, it's a separate legal entity, liable to the full extent of its assets, with the liability of the partners being limited to their agreed contribution. So whatever the capital contribution they have made, the liability will be only limited to the capital contribution and assets and liabilities of the firm. Okay. Now the personal assets will be liable. The main benefit of LSP is that it is taxed as a partnership. The taxation part is the same as partnership, but the benefits of being a corporate are more significantly juristic entity with limited liability. This has a limited liability. An LLP has the special characteristics of being a separate legal personality distinct from its partners. The LLP is a body corporate in nature. Okay, just for understanding that this. Then, rules in absence of partnership deed. Again, this is important. See, every partnership firm need to have a partnership deed. Every partnership firm need to have a partnership deed. Okay, so deed will have all the terms and conditions on which the business to be carried on. Okay. Now, if the partnership deed is not available, if it is not available, these are the assumptions, okay, which need to be taken. If the partnership deed is not available. Rules in the absence of partnership deed. That is, no partner has a right to salary. So when the deed is not there, partner cannot withdraw any salary. Okay. No interest to be allowed in capital. For whatever the capital contribution they have done, no interest to be provided to the partners. No interest is to be charged on the drawings. On the drawings as to how much of the partners are withdrawn in the money. On that also, there is no interest that can be charged from the partnership firm. Interest at the rate of 6% per annum is allowed on partners' loan to the firm. If partner is giving you additional loan, not as a capital, if any loan is giving, on that 6% interest to be allowed. Only 6%. If additional is there, it's not allowed. Only 6% is allowed. Okay. And when the deed is not there, profit and losses have to be shared equally. Okay, equal profit. That is 1:1. 50%, 50% generally. Two people are there. Okay, done. No, in the absence of an agreement, the interest and salary payable to the partner will be paid only if the profit. See, generally it is not to be paid. Okay, even though if it's a working partner and to be paid, no? And in that case, it can be paid only if there is a profit. Only if there's a profit. If there's loss, it cannot be paid. Only if it's only if there's a profit, the salary and the interest will be paid. Done. These are the five rules which you need to remember. No partner has right to salary, no interest to be allowed on capital, no interest to be charged on the drawings, 6% interest is allowed on partner's loan, and profit and loss to be shared equally. Okay, when the deed is not there. Then, so in partners capital account, we discussed about two types, right? One is the fixed capital method, and one is the fluctuating capital method. So, say for example, partner A and B are there. Okay, how the format of partners capital account is this will be the this will be the format. Okay, that is nothing but particulars A, B, and again particulars A and B. Okay, so here in the partners capital account, we'll be having all the opening balances, the reserves, all those things we will transfer. But mainly here, talking about the fixed capital method, in fixed capital method, we'll have the opening balances of A and B we have. Okay. Sure, after the opening balances, there are a lot of transactions which will be taken with the partner. Say if partner is taken over any assets, if any interest to be paid to the partner, for drawings if interest to be collected, if any goodwill to be paid or goodwill to be collected, all the transactions will be entered in the partner's capital account. Okay. So here in the fixed capital method, no. So basically all the transactions will be entered directly in the partner's capital account. Whatever transactions will be entered in the partner's capital account. If only one single account is maintained and all the transactions are being entered in that part, account, that's known as fluctuating capital method. In fixed capital method, what will happen is there will be two accounts. One is for the capital balance being maintained. Okay. Similar account, so the similar account, only one more account to be maintained, one is for fixed capital. Only the capital balance will be maintained, and whatever the closing balance or the fluctuating balance will be, that will be transferred to the capital. Okay. But all the transactions which has been occurred during the year, that will be taken out of partner's current account. So here basically partner's capital account, this will have fixed capital method, this one, partner's capital account and partner's current account. This will have two accounts. Capital account only will have a capital balance. Current account will have the rest of the transactions. Whereas in the fluctuating capital, all the transactions will be maintained in one single account itself. Okay, done. Then coming to interest on capital. A partner is not entitled to interest on capital as a matter of fact. But if there's an agreement, okay, generally no interest to be paid on capital. Okay. But if there's an agreement, the partner will receive interest on capital. It is paid at the agreed rate out of the profits. Okay, only out of the profits will be paid. Interest on capital is generally calculated on the opening balance. Whatever the opening balance is there, on that to be paid. With that, we have to make adjustment with respect to the additions or withdrawals, etc. Okay, after making that additions or deletions, then whatever the balance is there, on that balance will be paying the interest on capital. And the percentage will be given in the question. Based on that percentage, it will be generally it will be 12%. Okay, interest on capital will be at 12%. Then coming to interest on drawings. So if the partner withdraws any amount from the business, right, from the firm, so the firm can charge interest at the rate of 6%. Will be charging interest at the rate of 6%. Okay. Sometimes interest is not only allowed on capital, but it's also charged on drawings. In such a case, interest will be charged according to the time that elapses between the taking out of the money and the end of the. Okay. So here the different method which is being followed. Okay. There's something called product method. Okay. So whatever the amount has been withdrawn, say for example, amount 10,000 has been withdrawn. This has been withdrawn in the say 6 months. After 6 months is going. So final 6 months is there. So 60K will be the total amount. On the 60K, the interest will be charged. Okay. So the various methods. I've given this the exam point of view. Okay, we'll just discuss what is given. If the dates on which the amount are drawn are not given, if the dates on which amount drawn are not given, student will do well to charge interest for 6 months on the whole of the amount on assumption that the money was drawn evenly. So when the question is said, just take 6 months. Just take 6 months. Interest will be charged at 6 months. If the dates on which the amount are drawn are not given, the student will proven to charge interest for 6 months on the whole of the amount of the assumption that money was drawn evenly throughout the year. The assumption to be made and only for 6 months the interest to be charged. If the withdrawal, there are other types wherein the withdrawals are made even in the beginning of the each month. In the question specifically, it is told the withdrawal is made in the beginning of the month. When it is told it was made at the beginning of the month, 6.5 months. You have to take as 6.5 months for it to charge interest. Interest will be charged for 6.5 months. Similar way, if the interest is charged at the end of each month, then it will be 5.5 months. If it is beginning of every month, then it will be 6.5 months. If it is end of each month, then it will be 5.5 months. If nothing is mentioned in the question, then it will be 6 months. Okay. Then, if withdrawals are made at the beginning of each quarter, if it is made beginning of quarter, then it will be charged at 7.5 months worth of time. At the end of the quarter, it will be 4.5 months. 4.5 months given here. This you need to remember. Okay, in the question, whatever is given in the question, accordingly you have to take. If nothing is mentioned in the question, charge only for 6 months. If the question specifically says beginning of every month, which means you have to take 6.5 months. If it is end of every month, then take 5.5 months. If it is beginning of every quarter, then 7.5 months. If it is end of every quarter, then take 4.5 months. Okay, done. Guarantee of minimum profit. See, here the agreement might say that if a partner should get a minimum profit, say 1 lakh. So whatever the profit of the company doesn't matter, the partner has to get 1 lakh. The guarantee of minimum profit. Okay, there are 3 possibilities in this case. That is excess. Whatever the excess is there, excess is payable by one of the remaining partners. Say for example, A, B, C are there. Okay, A, B, C are there. A has to get 1 lakh minimum. Okay, so here C is giving this guarantee. If C is giving this guarantee, then C is liable to pay A. So excess is payable by one of the remaining partners. Anyone has to pay this amount. Then next period is that excess is payable by at least 2 or all the partners in agreed ratio. So B and C might agree at ratio. In that ratio, they might pay A. That might go 1 lakh. Okay, that is also possible. Otherwise, there is a third method where excess is payable by remaining partners in that profit sharing ratio. If nothing mentioned in the question, whatever the excess is there, whatever the excess to be paid, that to be paid in the profit sharing ratio between among the remaining partners. Question is silent about the nature of guarantee. The burden of guarantee is borne by remaining partners in that mutual profit sharing ratio. Okay, done. So our next topic is goodwill. So what is goodwill? Goodwill is basically a reputation of the firm. Goodwill is an asset, first of all. It is an intangible asset. Okay, it is an intangible asset. Basically, it is a reputation of the firm for which we can expect a profit. Okay, future in respect of profits expected in the future over and above the normal rate of profits. Okay. Why is this goodwill comes? Because of the location advantage, better customer service, possession of a unique patent right, personal reputation. All of these things might lead to goodwill. Okay. Then, what are the reasons? The necessity for valuation of goodwill in a firm arises in the following cases. What are those cases? We have 4 cases. Okay, when the goodwill arises. So when the profit sharing ratio among the partners are changed, say for example, initially they have the equal share, ABC. Okay, then they've changed it to 5:2:1. So A is getting more share here, which means that there is some amount of goodwill which is there. Okay. Because of that only he is getting more share. So when the profit sharing ratio among the partners is changed, okay, then when a new partner is admitted, the new partner is coming in. So he's getting additional benefit of what is there. So say for example, A and B is sharing the profit in 1:1. So now C comes in. When C comes in, he gets 1 share or 2 share. Okay. So for this share, there's nothing but he has to give in some goodwill. Okay. So here it talks about when a new partner is admitted. When a partner retires or dies. So whenever the partner retires, the old partners will be getting some shares from the retiring partner also. So basically it's called gaining ratio. Okay. So in that case also goodwill arises. When the business is dissolved or sold, that is basically dissolution. In description case also, goodwill arises. So these are the 4 cases where the goodwill done. Next is valuation of goodwill. Okay. In every partnership question, you might see this valuation of goodwill. There'll be a point with respect to this. Okay. And sometimes you can expect a separate question also for up to 4 to 5 marks on goodwill. Okay. There are basically 3 methods. That is average profit basis. In average profit, we have simple and weightage. Then we have super profit basis. Here we have number of year purchase, annuity basis, and capitalization of super profit. Then we have capitalization basis that is based on average profits. Okay. First we'll see average profit basis. Simple and weighted, both is there. So in average profit basis, what happens is that the profits of the firm for the previous years will be given. Say for example, 3 years profit is given. Okay. The profits will be given. So we need to find the average profit. We need to find the average profit. Simple average. First we discuss about simple average. So say for example, 3 years profit is given. We'll be finding the average profit, and based on that average profit, the goodwill will be calculated. If at all, if the profit has a trend, that is increasing trend or decreasing trend. If it has a decreasing, increasing trend or decreasing trend, then weights will be given to those profits. Weights will be given to those profits. Okay. So whichever is the latest year will have the highest weight. Latest year will have the highest weight. Okay. Based on the weights which is being given to the profits, based on that, the weighted average goodwill will be calculated. Okay. So weighted average to be used only when it has an increasing or decreasing trend. Otherwise, you'll have to always use simple average method. Okay. Then coming to super profit basis. In super profit basis, in case of super profit method, goodwill is valued on the profit on the basis of super profits earned by the firm. So the firm is earning any super profits. On that basis, the goodwill is calculated. How do we calculate the super profit? Super profit is equal to actual profit. Actual profit is earned by the company minus the normal profit minus the normal profit. Okay. Actual profit is average maintainable profit. Okay. So here, super profit to find actual profit we would have got for your question. But how do we find normal profit here? Normal profit is nothing but normal rate of return will be given in the question. Capital employed will be given. So when you multiply that, you'll be getting a normal profit. So when you minus normal profit and actual profit, you'll be getting a super profit. The difference is nothing but super profit if it's a positive. Okay. Then coming to capitalization basis. So there's a third method. Here the capitalization basis based on average. And here also we have annuity basis and capitalization super profit. From an exam point of view, this is not that important. So whatever I'm discussing here is more than sufficient. Okay. So I'm not discussing this annuity basis and capitalization super profit. If you want to read through this, it's there in the book. Just go through it, but I'm not discussing it. Okay. Then coming to the capitalization basis. Under capitalization basis, value of the whole business determined applying normal rate of business. Value of the whole business is determined applying the normal rate of business. That is nothing but whatever the profit is there, you need to divide by the normal rate of return. Okay. If such value arrived by applying normal rate of return is higher than the capital employed in the business. If it is higher, the difference is goodwill. Okay. The steps to be followed is I have seen. The steps to find the goodwill is given. You have to just follow these steps. Determine the normal rate of return. Determine NRR, that is normal rate of return. Find out the average profit of the partnership firm for which goodwill is to be determined. Average profit we need to find out first. Okay, and also normal rate of return will be given in the question itself. Determine the capital employed by the partnership firm. This also will be given in the question itself. Find out normal value of the business by dividing average profit by normal rate of return. So average profit by normal rate of return you have to divide. Okay. So here, whatever the value we are getting, then deduct average capital employed from the normal value of business to arrive at goodwill. So average capital employed minus the normal value of business to arrive at the goodwill. So if minus this part, you will be getting the goodwill. So goodwill is equal to normal capital minus actual capital. Normal capital minus the actual capital. Normal capital is nothing but average profit divided by normal rate of return. Normal capital is equal to nothing but average profit divided by normal rate of return. Okay, so these are the 3 things which you need to remember. 4 to 5 marks you can expect. Otherwise, it will be a part of a big question. Otherwise, goodwill will be a part of the question. So goodwill you will be seeing it in all the questions. So it's better you practice this. Okay. Done. So if you solve more and more questions, we'll be able to track it better. Okay, this is the first part. We have the remaining parts also. We have admission retirement part. In the text videos, we'll be discussing one by one. Thank you. Hello, students. This is the continuation to the partnership. Today we're going to discuss about admission of a new partner. Generally, the partnership can be started with two or more partners. Whenever the new partner is added, what are the changes to be done? We'll look into this in detail. Okay. Introduction. New partners are admitted for the benefit of the partnership firm. What is the benefit? In order to strengthen the management of the firm, new ideas, or in order to manage the finances. For any of the reason, new partners might be added. When a new partner joins the firm, it is desirable to bring all appreciation or reduction of value of the assets into accounts as on date of admission. So whenever the new partner is joining, say for example, the business is started on sorry, say the business was started on 1 2020. Okay. So now, as on day, whatever the land and building or plant and machinery or whatever the liabilities, whatever the assets and liabilities are there, the value might have increased and some of the assets value might have decreased also. So it is always important to revalue the assets so that whatever the profit and loss and revaluation can be transferred to the old partners. Whenever the new partner comes in, generally this revaluation of profit is done. Okay. Revaluation of assets. So we look into it in detail. Revaluation account or profit and loss adjustment. It is also known as profit and loss adjustment account. Whenever new partners are brought into partnership, assets are revalued and liabilities are reassessed. This account is debited with all reduction in the value. So basically, the format will be this. Format will be something like this. Revaluation account. Okay. Revaluation account. All increase in assets will be shown here. All decrease in assets will be here. All increase in liabilities here, decrease in liability will be shown. Okay. This is how you record all the transactions here. Okay. If at all there is an increase, what is the entry? If the assets of values increase, entry will be assets account debit to revaluation account. If there's any decrease in liability, liabilities account debit to revaluation account. So this is the entry which you need to be passed. If the value of the assets are decreased, that time revaluation account debit to assets account. Okay. If the liability value is increased, revaluation account debit to liabilities account. Okay, this is the entry which will be passed. And similarly, if the profit and loss from this revaluation will be transferred to the partners. Okay. And if it's a profit, it will be directly to revaluation account debit to capital account of all partners. If it is a loss, capital account of all partners to the revaluation account. Profit will be shown here, loss will be shown here. Okay, the same thing to be transferred to the partners account, partners category. Done. Okay. See, sometimes what happens in the partnership firm, no? So when the assets are revalued, say for example, land and building and as on 1/1/20 have a value of 10 lakhs. Okay. As on 24, the value is different 14 lakhs. So whenever the revalued assets, no, this 14 lakhs will be shown in the balance sheet. Sometimes what the partners might decide is not to show at the position values. The old values only will be shown on the books. Old values to be shown on the books. When the revised values are not to be recognized in the books. Okay. That time what to be done. So here there is something called memorandum of revaluation account is what we need to do. This account has two parts. This account has two parts. So basically, generally it is a revaluation account only. Okay. But it's divided into two parts. What you have to do? Same likewise what we discussed. No. Revaluation account, all increase in assets, decrease in liabilities to be recorded, decrease in assets and increase in liabilities to be recorded. So once we record, we will be getting a profit or loss. Say for example, profit is there. This profit will be shared to the old partners in the old profit sharing ratio. Okay. Then whatever the addition, increase and decrease of that to be reversed. Whatever your increase and decrease there to be reversed here. Okay. Whatever here it is that same thing to be reversed. Whatever increase in assets to be reversed by. Okay. then you'll be getting, initially if you've got a profit, then you'll be getting a loss. This loss to be shared between the new partners in the new profit sharing ratio. This is the only difference between revaluation account and memorandum revaluation account. This full theory I've given, but more or less this is the concept which I've explained. Main point to know to be noted here is point to be remembered is that the result of the first part of the memorandum revaluation account is shared by the old partners in the old profit sharing ratio. Okay. While the result of the second part is shared by all the partners, including the new one, in the new profit sharing ratio. Okay, done. Reserves in the balance sheet. If you have any reserves, general reserve, profit and loss account, that amount to be distributed between the old partners in the old profit sharing ratio. Okay. Debit all the reserves, credit the partner's capital account in the profit sharing ratio. Sacrificing partner is nothing but partner who's if any new partners coming, you'll be getting a new share. Say for example, the current share is 3:2 for A and B. Okay, C is coming in. C is coming in for the share of 2. That time A is giving 1 share. Will become 2 then. Again, B is giving 1 share. So it will become 1. So this fellow will have 2. So A and B is sacrificing 1 and each is sacrificing 1 each. Okay, so A and B is called the sacrificing partner. The partners whose shares have decreased as a result of change are known as sacrificing partners. Sacrificing ratio is nothing but the ratio in what they're sacrificing. Gaining partner is nothing but whoever is gained in the ratio. Okay. He is the gaining partner. Gaining ratio is nothing but the ratio in what he is being doing. Okay. Just given theory for the basic understanding. Then comes computation of new profit sharing ratio. Okay. Whenever the new partner is coming in, what is the new profit sharing ratio, which will be, let's say, for example, partner will be there. C is the new partner is coming in. So whenever it's coming in, what will be the new profit sharing ratio? We have 6 different cases here. We'll discuss that one more. When a new partner share is given, but the question is silent about the sacrifice made. When new partner share is given, say for example, C is a new partner. New partner share is given as 2/5. Okay. But the question is silent about the sacrifice made by the old partners. In this case, we will assume that old partners will share the remaining share in their old profit sharing ratio. Say for example, 1:1 they have. Okay. So in this ratio only they'll be sharing this share. Okay, that is what it says. Then coming to case 2. When new partner purchases his share from old partners in a particular ratio. So this partner C is as paying some amount to purchase the shares in a particular ratio. So whatever the ratio is given in the question, in that particular ratio will be purchasing. So whatever is purchasing, that will be the new ratio. And whatever the ratio in which they're sacrificing, that will be the sacrificing ratio. So that we will be able to find the new profit sharing ratio. In this case, the new ratio of the old partners will be calculated by deducting the portion given. That the minus whatever the particular ratio is given, whatever they're given. That is the minus to the new partner from the shares of the old partner. Okay. Then comes case 3. When the old partner surrenders a particular fraction, he surrenders, say for example, he had 3/5. He surrenders 1/5. So remaining is 2/5. So this is the surrender. He's surrendering a fraction of the share in the favor of new partner. In this case, following steps are followed. Determine the shares surrendered by the old partners. Find the new share of old partners by deducting the shares surrendered from the old share. Calculate share of the new partners by taking the sum of surrender share of old partners, cancel the new ratio. Similar step is given in detail. When the new partner acquires his share entirely from one partner, so from one particular partner, the share is being given. Similarly, it should be calculated. When the new partner acquires his shares from old partners with a certain ratio, in this, the sacrifice of each partner is deducted from that old share. Certain ratio they taken, similar to the particular ratio that was being given. Then coming to the hidden goodwill. See, sometimes in question, what happens? No, sometimes there is some hidden goodwill. How do we find the hidden goodwill? Say, for example, the new partner, that is the partner C, is coming in for a ratio of 1/5. 1/5. Say he is getting a capital of 20,000. 20,000 capital set. Okay. So for 1/5 share, if he is getting 20,000, what should be the capital of the firm? For 1/5 share, he is getting 20,000. Okay. So the capital of the firm has to be cross multiplied. For 1/5 share, it is getting this. Balance remaining 4/5 share we have. The 4/5 share, it will be 80,000. Okay, so basically the total capital of the firm has to be 1 lakh. So total capital of the firm has to be 1 lakh. Okay. But instead of if the capital of the firm is 1,20,000, then the remaining 20,000 will be a goodwill. Incoming partners capital, that is nothing but 20,000 into reciprocal of the share of incoming partner, that is 500, reciprocal opposite, into 5 will be 1 lakh. Total capital of the old partners, accumulated profits, general reserve, all to be taken into consideration, plus capital brought in by the new partner. Say that is nothing but 80,000. Incoming partner's capital into reciprocal of the share of incoming partner, that is nothing but 1 lakh. Total capital of the firm plus net accumulated profits and reserve, if any, plus capital brought in by the new partner. Okay. Say for example, all put together we have 80,000. Then the value of goodwill, this minus this will be 20,000. So the actual capital of the firm has to be 80,000 only, but they have 1 lakh. They have more than what is required. So that difference will be the goodwill. That difference will be the goodwill. Here it has to be 80, not 1 lakh 20. This will be say 80,000. This balance whatever was at 20,000 will be the goodwill. Okay, over and above what is there in the firm. Total capital over and above what is there in the firm, that is nothing but the goodwill. That is nothing but the hidden goodwill basically. Okay. With this we complete the theory part and the admission of a partner. So the next topic will be retirement of a partner. Okay, we'll discuss that also. Thank you. So we've discussed about the admission of a partner. Now we shall discuss on retirement of a partner. Okay. Done. So partner may retire from partnership firm because of old age. There might be various reasons why he is retiring, because there might be clashes between them. So he'll be retiring. Okay. Generally, when the partner retires, the partnership firm will still continue. Then the business of partnership firm may not come to an end when one of the partners retires. So other partners, they might continue the business, but they'll make some readjustment with the profit sharing ratio and other items which is there. Okay. Readjustment takes place in case of retirement of a partner, likewise in case of partnership. Whenever a partner retires, the continuing partners may gain in terms of profit sharing ratio. Done. So here, say for example, partners A, B, and C are there. C wants to retire. If C is retiring, say for example, they have a share of 2 by 5, 2 by 5, and 1 by 5. Okay, if C wants to retire, then the C share is there. This will be gained by A and B. Okay, then they'll have a new profit sharing ratio. Okay, so how do we calculate the profit sharing ratio? When the new ratio is given, sometime in the question, the new ratio will be given. So new ratio will be as given in the question itself. Gaining ratio will be new ratio minus the old ratio. When the new ratio is not given, Okay, that time how do we find the new ratio? The same old ratio between them, the same old ratios between them will continue. Okay, and for example here it is 2 to 1. No, when C retires, the new ratio will be 2 to 2 itself. And the gaining ratio will be the same old ratios between them. They will be gaining this in that ratio, the old ratio itself. Okay. Then when gaining or benefit ratio is given, when gaining or benefit ratio is given. When the benefit ratio is given, old ratio plus gaining ratio. Old ratio is already there, plus the benefit ratio is given, add them. So it will be old ratio plus gaining ratio. Gaining ratio is nothing but as given in the question itself. As given in the question itself. Okay. So even in case when in case of retirement, no, similar to admission, revaluation we have. Okay. So whatever the profit is there, that has to be shared between the whole partners, whole partner. So on the retirement of the partner, it is required to revalue assets and liabilities just as in case of admission. Similar to admission, whatever we do, same concept we have to follow here also. If there's revaluation profit, then such profit is distributed among the existing partners in the existing ratio, old ratio basically. On the other hand, if there's a loss, same to be shared between the partners. To arrive at profit or loss and revaluation of assets, the liabilities revaluation account, the profit and loss adjustment account is working. Here, to arrive at profit or loss on revaluation of assets and liabilities. To arrive at revaluation of assets and liabilities, revaluation account or profit and loss adjustment account is working. The other name is profit and loss adjustment. Revaluation account or profit and loss adjustment account is closed automatically by transferring the profit or loss balance to the partner's capital. So the balance should be transferred to the partner's capital account of the old ratio. Okay. Then final payment to the returning partner. So this is very important topic here. So when the partner is returning, what all payments to the existing partner that the firm has to make it. One is the transfer of goodwill, whatever the accumulated profits or the surplus, whatever is available, no, the P&L account, the reserves, all that to be transferred to the old partners. Transfer of goodwill, whatever shares which is there, that also to be transferred. Transfer of profit and loss and revaluation, profit and loss and revaluation, so to be transferred. Okay. After adjustment of the above mentioned items, the capital account balance standing to the credit of the returning partner represents amount to be paid to. Whatever after transferring all of those things, whatever the balance is reflecting in the partner's capital account, that balance to be paid. Here, the profit till the date of retirement is not paid to him. But only in case of death, the profit till the date uh, till the date of death is paid. But here, profit till the date of retirement is not. Only the reserves, goodwill, and revaluation is paid. Okay. After adjustments, okay, the continuing partners may discharge. So how are they going to discharge now? The balance whatever is payable to the retiring partner. So here, either they can discharge fully, that is by retiring partner's capital account to bank account. They can pay it one shot and it's here. Otherwise, a part of the amount will be paid as a loan as well. So here in this case, retiring partner's capital account, part which is treated as loan is credited and remaining is paid to the bank. Okay. Here, as per the agreement, we have three different types. So as per the agreement, any of them can be followed. As a rule, the payment is made according to the terms of the partnership agreement, which might provide one of the following alternatives. One of the following alternatives. Repayment may be made in installments over a period of time. Okay. So say for example, 10 lakhs is payable. So this 10 lakhs can be paid in installments over a period of time. Say 5 years, say 2 lakhs per year, and 5 years it can be paid. Or in 1 year only it can be paid, and at the end of the 1 year will be paying the sum. Okay. Whatever the agreement states, based on those terms, it will be paid over the period of time. And the interest is paid on the outstanding balance, which will be treated as loan of the outgoing partner. Okay. Interest at the rate of 6% to be paid. The amount due may be treated as a loan to the firm, and in return, the firm will either pay interest at a fixed rate or share of profit of the firm. So here, either the whole amount is treated as a loan and interest at the rate of 6% is paid, or share of profit till the capital balance is till the time of repayment, a share of profit is being paid to the partner. Okay. Or an annuity may be paid to the retired partner for life or for an agreed number of years for the life of some retirement of some dependent. Annuity amount also can be paid to the retiring partner up to a certain number of years. They say yearly so much amount, lump sum amount can be paid in order to clear the balances. Right, the proper second one. In question, it will be given which approach to be followed. Okay, accordingly we can follow that. Then comes joint life policy. This is also very important. Okay. What is joint life policy? Joint life policy is nothing but it's a policy which is taken by the partners. Either they can take separate policy or there's a whole. This is joint life policy. This is also known as there's one more policy that is called separate life policy. Wherein if the partners A, B, and C are there, individually for each partner separately we will take. But here together for all the partners together we'll take a policy, life policy. Okay, that is known as joint life policy. Okay, here the main objective is that whenever the partner is retiring or whenever there is a death of a partner, to make the payment will be easier. Okay, the objective of taking such a policy is to minimize the financial hardship to the event of payment of large sum to the legal representative to the deceased partner or the retiring partner. But here, what is accounting treatment for the joint life policy? There are three different types of accounting treatment, three methods basically. First one is when the premium is treated as an expense. Whatever the here annual premium to be paid, Same like a life policy, annual premium to be paid. Whenever you're treating this annual premium as an expense, okay, when you're treating it as an expense, whatever the amount paid, it is charged to P&L account directly. When the premium is treated as an expense, then it is closed every year to transferring to profit and loss account. Whatever the amount is paid, that is being transferred to profit and loss account. In case whenever the partner retires or in case of death, or whenever this value, whatever we get from the insurance company, that is either surrender value or the assured value. That amount is treated as nothing but gain. That amount will be treated as gain and will be shared between the partners in the profit sharing ratio. In this case, complete amount received from the insurance company, either on the surrender of the policy or on the death of the partner, becomes a gain. The whole amount becomes a gain, and will should be shared between the partners. So here the accounting entries are there. We'll just look into it. So initially, when you're making a premium payment, that will be nothing but joint life policy insurance premium account debit to bank account when you do the payment. So this whatever joint life policy is should be transferred to PML account. PML account debit to joint life policy insurance premium account. Then on maturity, the entry will be nothing but insurance company or bank, whatever. If you're receiving the bank account, or if you're receiving cash, then bank account debit to partner statement. Okay, these are accounting entries. So this is the accounting entries when the premium is treated as expense, when the premium is treated as an expense. Okay, we'll see. Look into the second case. In the second case, what happens is that when the premium is treated as an asset, so whatever the amount on a yearly basis you'll be paying, no, that amount is treated as an asset in the balance sheet. Say for example, you have paid 1 lakh for the first year. Okay. This is shown in the asset side. This whatever the amount is paid, this is shown on the asset side. But what happens in the year end is this policy you would have paid 1 lakh, but surrender value might be 70K. Okay. This difference to be charged to payment account. The balance sheet should be reflecting at 70K value, at 70,000 value, not 1 lakh. Initially, you'll be recording it at 1 lakh, then later at the year end, that has to be brought down to the surrender value. That difference will be transferred to the P&L account. Okay. In this case, insurance premium paid is first debited to the life policy account, and credited to the bank account. At the year end, the amount in excess of the surrender value is treated as loss and is transferred to profit and loss account. That is nothing but 30K is being treated as loss and transferred to profit and loss account. In this case, the amount received from the insurance company in excess of the surrender value, say for example 70K, from insurance company you receive 1.5 lakhs. So the remaining 80K is nothing but treated as a gain at the time of receipt of such amount, which is transferred to capital account of the partners in the profit sharing ratio. The balance amount is treated as a gain and shared between the partners. Okay. Then here there is another method wherein the premium paid, no, it is treated as an asset, and also you create a joint life policy reserve account. So what happens here is similar to the second approach, but here what happens here is at the year end, so initially be treating it as an asset, okay, but also at the year end we'll be transferring a certain amount, the amount, the premium amount that is being paid. No, some amount you'll be transferring into the joint policy reserve account. Okay. This joint policy reserve account is nothing but a liability. This will be another liability as a joint policy reserve. So here in the balance sheet, what happens is both your asset side, you'll have a joint life policy and joint life policy reserve account. Will be shown both 1 lakh, 1 lakh. Okay. This whenever you're making a payment, this at the year will show transfer. Okay. Then what happens is whenever the surrender value is there, say for example, surrender value is 30,000. So the entry will be in such a way that this joint life policy reserve account will be debited for 30 and joint life policy asset account will be credited by 30. So both will be shown at the value of 70K and 70K. Okay, debit this, credit this. Both will be shown at the value of 70K, 70. This is how you record. Under this method, premium paid is debited to the policy account and credited to the bank account. Similarly, at the year end, amount equal, this is addition step. At the year end, amount equal to the premium is transferred from profit and loss appropriation account to the policy reserve account. After this, policy account is brought down to a surrender value. How do you bring it to the surrender value? By debiting the joint life policy reserve account with the amount which exceeds the surrender value of the policy. Okay. Thus, in this method, policy account appears on the asset side of the policy, asset side, and the policy reserve account appears on the liability side. Both on the asset side and liability side, both you can see. Okay. Both these accounts appear on the balance sheet, the surrender value of the policy. The method is different from the method discussed in 2 above. On the death of a partner, joint life policy reserve account is transferred to joint life policy account and then the balance is transferred to the partner's capital account. So what happens here is whenever you receive amount, the amount in excess of the asset side, that is if you receive 1.5 lakh, this excess will be transferred to the partner's capital account. But then what happens to this 70K which is there here in reserve account? This is transferred to the PNL. On death of a partner, joint life policy reserve account is transferred to the joint life policy account. Joint life policy reserve account is transferred to the joint life policy account, and then the balance is transferred to the partner's capital. And then the balance is transferred to the partner's capital. Okay. Then coming to the separate life policy. Instead of life policy taken jointly in name of all partners, you can mention instead of taking it on A, B, C together, individually will be taken for A, B, and C. Okay. For each of them by paying the premium. In case of retirement, what will happen? The surrender value, whatever is there, no? Surrender value, not on, say for example, C is retired. So surrender value of A is 10K, B is 5K, C is also say 15K. Okay. Whenever partners retiring, not only the surrender value of 15K will be taken, the total surrender value you have to take. That is nothing but 30K. So total will be 30K. Into C share, say for example, share is 1/5. 1/5 will be, that is nothing but 6,000. 6,000 will be the share of C. 15K is not the share of C. 6K is the share of C. Okay, this is how you need to consider. Instead of the life policy taken jointly on the name of all the partners may take individual life policies for each of them by paying the premium from the firm. In the event of retirement, the retired partners are entitled for the proportionate amount of the life policies of all the partners put together. Of this total amount, his share, you have to take that is nothing but 6. Okay, this is all about the retirement of a partner. So next topic will be looking into death of a partner. Okay, thank you. In today's discussion, it will be death of a partner. Okay. So here, just one correction in the previous topic, that the retirement of a partner. Whenever the reserve is created, no, that reserve, joint life reserve account, that reserve will be transferred to the partners itself. Okay, I told to be transferred to the PNL, but it will be transferred to the partners capital account itself. Joint life reserve, whatever is there in the liability side, that will also be transferred to the partners account itself. Okay. Done. Now we'll discuss about the topic death of a partner. Here, the problem arising on death of a partner is similar to those of arising on retirement. Retirement and death are more or less similar. There are few changes. We'll look into that one time. Assets and liabilities have to be revalued same, and the resultant profit and loss transferred to the partner's capital account. Okay. Goodwill is dealt with exactly in the way already discussed in case of retirement. Okay. Treatment of joint life policy will also be the same as in case of retirement. However, in case of death of a partner, firm would get the joint life policy value. The sum assured value is that, not the whole value will be getting. But otherwise, the treatment is the same. We'll look into the journal entries on this also. Okay, done. Amount payable to the legal representative of the dead partner. If the partner is dead, the balance amount which will be paid to the legal representative of the partner. Okay, what is the amount payable? When the partner dies, the amount payable to him or her is paid to his or her legal representatives. The representatives are entitled to the following. What are the amounts that need to be paid? The amount standing to the credit of the capital account. The closing balance order is showing, that balance to be paid. Interest on capital, if anything is there, to be paid. If it's there in the partnership team, then that to be provided. Share of goodwill to be paid. Share of undistributed profits or reserves. If we have any reserves now, that also to be paid. And revaluation profit or loss also to be taken into account. Then share of profit. This is the important point. Share of profit up to the date of death. So we need to prepare a P&L suspense account. P&L suspense account to find the profit or loss up to the date of death. So that profit also to be transferred to the legal representative. Okay. Then share of joint life policy. This also to be paid. Legal representatives are liable for what are they supposed to pay? That is another interest on drawings. Drawings, if anything is there, that to be paid. Interest on drawings, share of loss and revaluation of assets and liabilities. If there's any loss, they are also liable to pay these amounts. So next is share of loss that have occurred till the date of death of his till the date of his or her death. If the profit is there, that will be added to the balances, in the payable balances. The loss is that the legal representative is liable to pay this balance. These are the four items which they will be liable. But here in this case, to find out the profit, paying suspense account will be open. In this account, we find out the profit and loss till the date of death. Okay, done. Then calculation of profit up to the date of death. So while calculating profit up to the date, now say for example, the year begins from 1st of April, so here till 31st March. Yeah, okay. Say the partner dies on 30th of September. So there is 6 months. That is starting about 6 months. Okay. So for the 6 months profit to be calculated, how do we calculate profits? What is the base here? So there are basically two options here. One is that time basis and turnover sales basis. Time basis. So okay. Such profit is calculated through P&L suspense account. So the profit is calculated through P&L suspense account after ascertaining the amount due to the deceased partner. It should be credited towards executor's account. Executor is nothing but the legal representative. If the death of a partner occurs during the year, the representative of the deceased partner are entitled to his or share until the date of death. Such profit is ascertained by any of the following two methods. Time basis. Time basis as in, say for example, here in this case it is 6 months. Okay, so here in this case it is 6 months. Say time is what happens generally in a sense. Last year's profit will be given. Say last year's profit is 1 lakh. So for 6 months, half year, the profit will be in the current year 50K. Okay. Based on the time basis, we have to calculate. If it is for 9 months, then again 9 by 12. Turnover or sales pitch. See here, whenever we find the profit based on turnover or sales pitch, we take the turnover, the sales is even throughout the year. Okay, it is even throughout the year. Say for example, the sales made till the there will be a certain percentage given till the 9 months period is say say 5 lakhs turnover. Okay, so it is assumed that the turnover is same during each of the months. Okay, based on that that we find the profit. Will be given in the question the rate at which the profit to be found. We can just find through that. Okay, one is the time basis, one is turnover or sales basis. Based on this, we can find the profit. Okay, done. So from exam point of view, not that important. Just we cover the theory. Okay. Then coming to the joint life policy in case of death. In case of partnership, partners generally get joint life policy in name of all partners. If partners expires, then partners are entitled for the sharing joint life policy. Similar way, we discussed three methods. One, if you are transferring to the P&L account, the premium paid is transferred to P&L account. One is it's treated as asset. Next, it is treated as asset and also reserves are maintained. So these are the three methods. That is premium method, surrender value method, and joint life policy method. Okay. Coming to the first method. If the joint life policy does not appear in the balance sheet, if it does not appear in the balance sheet, means you're charging it to P&L account. Then the firm will gain on the death of a partner. For example, A, B, and C are in partnership, sharing profit and loss at the ratio of 5:2. They took a joint life policy for 1 lakh. Now, if A dies, the firm will receive 1 lakh. This 1 lakh, whatever it's been received, this 1 lakh whole amount is made as gain. The increase will be bank account debit to joint life policy account 1 lakh. Okay. Then after that, whatever the joint life policy account, the amount which is being received, right? The joint life policy, this will be transferred to the partners in the profit sharing ratio, 5:3:2. So joint life policy written off and credited to the old part of the profit sharing ratio. Okay, done. Coming to the method two. If joint life policy appears in the balance sheet at surrender value, this is the second method, treated as an asset. It is treated as at surrender value. Okay, so what happens here? If you're receiving 1 lakh, so bank account debit to joint life policy account, 1 lakh will be shown. Okay, but in the balance sheet, the surrender value of the asset is 10,000. So what will happen? The joint life policy account will have a balance of 1 lakh minus 10,000 will be nothing but 90K. 90K will be transferred to the partners in the profit sharing ratio. Okay, done. If joint life policy appears in the balance sheet at surrender value, same. Also, the reserves have been maintained. Okay. Similarly, we have 1 lakh which is being received, and 10,000 is the surrender value. So we'll be receiving 1 lakh, that is nothing but bank to joint life policy account 1 lakh. But here, the joint life policy account, whatever the balance 90,000 is, that will be shared to the partners, the profit sharing ratio. Okay. Then also there's one more thing, that is nothing but reserves. Joint life policy reserves will be there. Okay. That reserves also will be shared to the partners in the profit sharing ratio. Okay. Reserves as in 10,000 reserves. So I said joint life policy also will be showing 10,000. The reserves account also will be showing 10,000 balance. So whenever the amount 1 lakh has been received, this will be this amount will be credited and the joint life policy account will be debited. So the net balance will be 90K. 90K will be transferred to the free partner in the profit sharing ratio. And this 10K also will be shared to the partner in the profit sharing ratio. Okay. Boom. Then separate life policy in case of in case of separate life policy, what happens is the legal representative will be entitled to receive share in the insured value equivalent to the profit sharing ratio of the deceased. And in addition, you will receive the share in the surrender value of other partners. Say, for example, the sum assured value is 1 lakh. So, if one of the partners, say, for example, A, B, and C, the surrender value is 10K, say 20K, say here also it is some 5K. Okay. Here, what happens is, sure, this 1 lakh which is being received. No, this 1 lakh share is not the share of C. So, what happens here is, in 1 lakh, he'll be getting his share. That is nothing but his share here we saw is 2 by 10. Plus, additionally, he'll also be getting a share from this. That is nothing but 10 plus 20, 30K. 30K plus 30K into 2 by 10. Okay. On this also, he'll be getting this. So, totally, he'll be getting 20,000 plus 6,000. That is nothing but 26,000. This will be the share. So, what he won't be getting 1 lakh. He won't be getting 1 lakh. This is very important. He won't be getting 1 lakh. He'll be getting 26K. How? Because out of this 1 lakh, we should not take surrender value for the partner who's dead because this is the sum assured value. Sum assured value is 1 lakh. So 1 lakh into his share, that is nothing but 1 lakh into 2 by 10. Then coming to the surrender value of partners A and B. This is addition which will be getting in spite of this. So 10 plus 20 is 30K. 30K into 2 by 10 will be getting 6K. So totally it's 26K will be getting. So these are the things which you need to remember in case of death of a partner. Yeah, otherwise everything remains the same. One more thing need to be remembered is the share of profit which need to be paid to the partner in case of death. P&L suspense account to be created. Okay. Otherwise, more or less everything is the same. Okay. Thank you. We'll see the next topic.